In September 2025, France's public debt quietly crossed a line that economists had warned about for years. It reached roughly $3.5 trillion, about 117% of the country's entire economic output. On paper, France was still one of the world's richest nations, still issuing bonds with ease, still protected by the credibility of the euro. And yet, behind those numbers, something far more fragile was unfolding. Interest rates were no longer close to zero. Politics had become gridlocked. And for the first time in decades, markets were no longer asking how much France owed, but whether it could still govern its way out of the problem. How did one of Europe's core economies end up here? And more importantly, who will pay the price if it doesn't find a way out? France's debt story is not new. It did not begin with a sudden crisis or a dramatic collapse. It is the result of slow accumulation, policy choices layered over decades, and a political system that learned to live with deficits as if they were harmless background noise. To understand why today's situation is different and why it matters far beyond France, we need to step back and look at how the system was built. France is not Greece. It is not a peripheral economy. It is the Eurozone's second largest member, a founding pillar of the European project, and one of the world's biggest sovereign bond issuers. Its debt market is among the most liquid on Earth. French government bonds are held by domestic banks, pension funds, insurance companies, foreign investors, and the European Central Bank itself. For years, that demand created a sense of safety. As long as investors kept buying, deficits did not feel urgent. After the global financial crisis of 2008, and even more after the pandemic, deficits became normalized. Governments everywhere borrowed to stabilize their economies, protect jobs, and prevent social collapse. France did the same, but it never fully reversed course. Even during years of economic growth, its budget remained structurally in the red. Spending was politically easier than reform. Borrowing was cheaper than confrontation. For a long time, this worked because interest rates were extraordinarily low. In some years, France could borrow for 10 years at close to 0%. In real terms, inflation was eroding the debt faster than interest was increasing it. Debt looked manageable, even abstract. The bond market appeared calm. The euro provided a shield. But debt is not static. It has a rhythm. Each year, a portion of it matures and must be refinanced at prevailing rates. And when rates change, the cost of yesterday's decisions suddenly becomes visible. That shift began in 2022, when inflation surged across advanced economies. Central banks, including the ECB, raised rates at the fastest pace in decades. The era of free money ended almost overnight. For countries with low debt, the adjustment was painful but contained. For countries like France, with large refinancing needs year after year, it was transformative. By 2025, interest payments alone were consuming tens of billions of euros annually, rivaling or exceeding entire ministry budgets. Money that once funded schools, hospitals, housing subsidies, or infrastructure was increasingly diverted to servicing past borrowing. This is the hidden mechanism that makes debt dangerous. It does not explode. It slowly crowds out everything else. At the same time, France's political system entered one of its most unstable periods in modern history. Fragmented parliaments, razor-thin majorities, and rising polarization made budget negotiations increasingly difficult. Passing structural reforms became a high-risk gamble. Every attempt to cut spending or raise taxes sparked protests, strikes, and political backlash. This is where economics and politics collide. Markets do not simply look at debt ratios. They look at credibility. They ask whether a country can take difficult decisions when conditions worsen. When politics becomes paralyzed, even a rich country starts to look fragile. Each French bond auction now carries a subtle tension. Investors still buy, but they demand compensation for uncertainty. Even a small increase in yields compounds over time. A few tenths of a percent can translate into billions in additional interest costs. That, in turn, worsens deficits, forcing more borrowing, which feeds back into market concerns. It is a loop, not a cliff. This dynamic is especially dangerous in a monetary union like the Eurozone. France does not control its own currency. It cannot devalue to regain competitiveness or inflate away its debt independently. It shares a central bank with countries that have very different fiscal cultures and political constraints. Any sign that France is slipping places pressure on the entire system. The European Central Bank is often seen as the ultimate backstop, and to some extent it is. But the ECB's mandate is limited. It can stabilize markets in moments of panic, but it cannot permanently finance government deficits without undermining its credibility and fueling inflation. The more a country relies on implicit central bank support, the more investors question the sustainability of the arrangement. Meanwhile, the real costs are felt far from bond desks and parliamentary chambers. In cities like Paris, Lyon, and Marseille, housing affordability has deteriorated sharply. Young workers spend an increasing share of their income on rent, delaying family formation and home ownership. In rural areas and smaller towns, public services have been quietly reduced or consolidated. Hospitals operate under strain, schools face shortages, infrastructure ages without replacement. These are not abstract trade-offs. They shape everyday life. When governments talk about fiscal adjustment, they are talking about concrete sacrifices. Fewer benefits, higher taxes, delayed investments. And those sacrifices are rarely distributed evenly. Wealthier households can buffer shocks. Younger and lower income groups cannot. France's social model was built on a promise that the state would provide stability, protection, and opportunity across generations. Debt allowed that promise to be extended longer than it otherwise could have been. But debt also shifts costs forward in time. Eventually, someone has to pay. Comparisons help clarify what makes France's case unique. Italy, for example, has long carried even higher debt ratios, but it also runs primary surpluses and has a political culture shaped by constant market scrutiny. Germany, by contrast, kept debt lower and prioritized fiscal discipline, giving it room to maneuver during crises. The United States runs massive deficits too, but issues debt in its own currency and benefits from the dollar's global dominance. France sits uncomfortably between these models. It has neither Germany's fiscal buffer nor America's monetary autonomy. Its strength lies in scale and institutional credibility, but those strengths depend on political coherence. The danger is not an immediate default. It is a slow erosion of choices. As interest costs rise, the range of viable policies narrows. Governments become reactive rather than strategic. Long-term investments are postponed in favor of short-term fixes. Political debates become zero-sum because every euro saved or spent feels existential. Looking forward, France faces three broad paths. The first is denial, continuing to borrow, hoping that growth or inflation will eventually solve the problem. This path relies on favorable conditions that may never return. The second is abrupt austerity, cutting spending and raising taxes quickly to reassure markets. History suggests this risks social unrest and political instability. The third path is the hardest, gradual but credible reform that improves productivity, targets spending more effectively, and rebuilds trust over time. None of these paths are painless, but the choice matters not just for France, but for Europe as a whole. A financially constrained France is a weaker geopolitical actor. It has less room to invest in defense, energy transitions, or industrial policy. Its domestic struggles become European problems. In the end, France's debt crisis is not really about numbers on a balance sheet. It is about governance in an age of limits. It is about what happens when societies promise more than their institutions can sustainably deliver. And it is about whether democracies can still make long-term choices in a world that punishes hesitation. Debt allowed France to postpone difficult conversations for decades. Interest rates have now forced those conversations into the open. What happens next will shape not only France's future, but the stability of the European project itself. Because when a core country starts to wobble, the question is no longer whether the system can absorb the shock, but whether it has learned how to prevent the next one. What makes France's situation especially fragile is not just the size of its debt, but the timing of when its consequences are now becoming unavoidable. For years, debt felt like a distant abstraction, a number discussed by economists, debated in parliament, but largely invisible in everyday life. That illusion is breaking. As borrowing costs rise, the consequences are no longer theoretical. They are immediate, political, and deeply personal. In France, the state plays a central role in smoothing life's risks. It subsidizes housing, supports families, stabilizes employment, and absorbs shocks that markets would otherwise pass directly onto households. This model worked best when the cost of money was low and growth, even if modest, was steady. But higher interest rates change the arithmetic. Every euro spent on debt servicing is a euro not spent on protection. And once those trade-offs become explicit, the social contract itself comes under strain. You can see this tension playing out across the country. In urban centers, housing shortages collide with shrinking public investment, pushing rents higher while social housing projects stall. In smaller towns, local governments quietly delay maintenance, merge services, or raise fees, knowing that central transfers are under pressure. Public sector workers, teachers, nurses, transit staff, feel squeezed between rising living costs and fiscal restraint, while being told that there is no money left. This is where debt stops being a macroeconomic issue and becomes a political accelerant. Every budget debate turns into a battle over identity and values. Who should be protected first? Retirees or young workers? Urban voters or rural regions? Taxpayers today or taxpayers tomorrow? These are not technical questions, but moral ones, and when answers are postponed, polarization fills the gap. International investors watch these debates closely, not because they care about France's internal politics, but because politics determines credibility. Markets are not alarmed by disagreement. They are alarmed by paralysis. When reforms are announced but diluted, when budgets are passed but immediately contested, confidence erodes slowly but persistently. Risk premiums rise not from panic but from doubt. France's challenge, then, is not simply to reduce its debt ratio. It is to demonstrate that democratic governance can still function under financial constraint, that it can make choices that are painful but coherent, gradual but credible. This is far harder than imposing emergency austerity. It requires rebuilding trust between the state and citizens, between generations, and between France and the investors who finance its present. History offers no easy template. Countries that adjusted too quickly often paid with social unrest. Countries that adjusted too slowly lost control of the process altogether. France now stands at that narrow midpoint where delay increases costs, but haste risks fracture. The decisions made in the next few years will shape not just fiscal outcomes, but the durability of the French model itself. In that sense, France's debt crisis is less about accounting than about agency. It asks a fundamental question facing many advanced economies. Can societies built on protection and stability adapt to a world of higher costs, tighter margins, and harder trade-offs without losing the cohesion that made them successful in the first place?